Chastain. I am the best-selling author of my book, Girl, Get Your Shit Together, intentionally meant to ruffle some feathers on that. And a little history about me is I am a UNLV graduate. I graduated from UNLV in 2003 with my degree in communication studies. From there, I jumped right out of my undergraduate experience and right into working for UNLV. I was an undergraduate recruiter. And then from there, I became an advisor at the Honors College. And at 2011, when I left UNLV, I was the outgoing director of advising for the Honors College. So my first love and heart is working with students, which is why I love being here with you, having worked with some of the best and brightest students on campus. Doing what I do today brings everything full circle for me. Being able to teach about finances, a little history about how I got into money. I did stay home for a few years after leaving UNLV with my son, who is now 13. He was 3 at the time. And I thought that I wanted to be a stay-at-home mom, and I realized very quickly that I did not. And I had to figure out what I wanted to do with my life, having left the university. I had a very stable life at the time. I had been able to save because of my employment at UNLV. I had a nice healthy 401k, about $100,000. And I was a homeowner, married for nearly like 8 years at the time. And I had my son, and life was moving pretty well for me. I thought it was a good time to take a risk, leave my comfortable job, stay home. And when it was time to get back into the world of work, I found myself at a crossroads. I was like, do I go back into higher education? What do I do? And how do I want to help people? I decided to go into the world of money because honestly, I can't think of a more important way to make a difference. And also, I knew as a financial advisor, I would have freedom as a business owner. There were a lot of reasons to choose that industry. A few years into the industry, I was at another crossroads. I was not very happy as a financial advisor, and also my life had taken a turn. I share this story with you because I want you to know that life doesn't always look straight up. And as a student in your new careers, as alumni, there are a lot of different paths you'll take in life, and financial stability for me came and went very quickly. I went from a very cushy lifestyle to almost out of money in a very short amount of time, trying to invest in my business, trying to create a successful career as a financial advisor. And what I know now that I didn't know then is I just wasn't living my most authentic life in a career the most authentic way that I thought I could. And when I shifted from working with pre-retirees, and I was working with millionaires and learning so much about money. I thought I was drinking from a fire hose. I was able to take all of that knowledge and all of that wisdom, having gone through financial breakdown myself and rebuilding myself to say, how can I help young people? How can I help young women in particular, which is why I wrote my book, to hear a message that I think is so important to hear. And so in addition to talking about money, I want to talk about life, and I do that every day. And ultimately, if your life is not intimately connected to your relationship with money and the decisions you're making with money, I feel like you're missing something anyway. So I know I shared some of that last time around, but I thought it was important to share for some of you. Things are fine for me. I have rebuilt after going through a divorce, draining my retirement account. I want you to hear too that no matter when you start, how you start, you can rebuild. So with that, I want to jump into today's conversation, which is about investing and ultimately wealth. I can only see a few of you, but you can raise your hand through the chat function also, or through the little Zoom functions. How many of you want to build wealth in your life? Yeah, I can see your hands. I can see, yeah, Rocio, you raised your hand. We all do. We invest in ourselves. Yeah, absolutely. We want to build wealth. We want to know that we're making the right decisions. And sometimes for a lot of reasons, we don't. And this is a healthy conversation to have no matter where you're at in your life today, to say, okay, how do I make sure I'm focusing on the right things? In my world, the steps to building wealth are to first control and have clarity of your money. So we start with simple ways of tracking our money and keeping on top of our expenses, making sure we're not getting into debt, or if we are in debt, we're getting out of debt. So that's the foundation of building wealth. You can't build wealth if you don't have that foundation, that you really have control of clarity of your money. The second thing is adopting a wealthy person's mindset. I am a blue collar girl. My dad was a stagehand on the Strip. He helped founded Siegfried and Roy's show back in the day at the Frontier before there was Mirage. I grew up in a dirt road in Las Vegas. My mom was a stay-at-home mom. My dad never made more than $60,000 a year. It's safe to say growing up, I did not have a wealthy person's mindset. It was actually very scarcity mindset, not to any fault of their own, but it was always, there isn't enough. We've got a budget. We've got it, there was never, it just never felt like we had enough money. And I don't know if that relates to any of you, but thinking about a wealthy person's mindset, that is very different than having to budget and watch our money and make sure that we're making our dollars stretch. There's a fixed mindset when it comes to money versus a growth mindset when it comes to money. And in order to create ultimate wealth, you've got to make sure you have the right mindset and you're taking the right action. And then third, you've got to learn how to save so that you can invest. Saving starts first, having a foundation, knowing how to save, knowing where to save, believing in yourself that it's important, and making decisions to save is one of the most basic things that you can do right now in order to get moving into a wealthy mindset and ultimately having the wealth that you want. So for any of you who feel comfortable, I know Christopher, you were really helpful with this and sharing, and Melissa, but for any of you today, I'd love to know from you, what's important about investing to you? Assuming that it is important. Yeah.
The important thing for me for investing is making sure I'm investing it in the right things, right? So when you look at Bitcoins or cryptocurrencies, that's very volatile. So it's something I'm not as comfortable going into, and diversifying my portfolio to ensure it can, live through different crises, because we're living through different ones throughout our lives.
Yep, exactly. That it's going to tolerate the swings of the economy, that you're investing it in places that you feel safe enough to invest it based on your risk tolerance. Everybody has a different risk tolerance. Those are really great, really great. Yep, that's why it's important to me too, and a lot of other people. Thank you, Jasmine. Anyone else? Why is it important to you? Assuming that it is important to you. Maybe it's not yet.
To me, it's important just because when you save, and you see this money, after such hard work, I think for me, it's so important to invest, to put that money to work so that you can get even more money than what you have now. And you're still gonna have to work hard, but you're actually gonna see more movement in your money than just work, and save.
Agreed. So what I think I'm hearing you say is that your money then can work for you.
Correct. Yes.
Got it. One more share. Anyone else want to share why investing is important to them?
Very much going along the lines of Jasmine and Rocio, making sure that I'm investing in the right companies that I believe in, that, share the same beliefs that I do, diversify so that I can survive in different methods and different levels, if you will, of investing, but also to make a difference in my goals. And one of them being making a difference in my family and the legacy that I'm going to leave for generations to come afterwards.
Absolutely. I gave this similar talk to a group of women at UNLV a couple of summers ago, and there were several women in the room just like you who said, I don't just want to do this for me. I want to make sure I can do this for my family. I can do it for my future children and for my parents. I can help them. For so many reasons, it's important. Thank you for sharing that. What do you need investments for? You already spoke into that. More specifically, though, what are some specific things that you need investments for?
A home.
A home, absolutely.
Retirement.
Yes, we call it a work optional lifestyle in my world. Maybe you won't ever retire, but at some point, you want to be able to have a work optional lifestyle, yes? Where you can choose whether or not you work. Anything else you need investments for? How about giving? I know some people in particular at UNLV who have created wealth for themselves, and they have investments that they can then use to give back. How many of you is that important to?
Mm-hmm.
Definitely. Lots of reasons that investments are important. And then current day, what are some words that describe your relationship with investing? That's different, right? What you know and how you feel can be different sometimes. What's your relationship with investing?
I guess, yeah, just, oh, sorry.
Sorry, Rosia. Just continually dating, right? So just like any relationship, a friendship, a boyfriend, whatever it may be, you have to constantly work on it and grow.
Yep.
It's constantly changing.
Yep, working on it, constantly learning about it. I love that analogy to dating. What else? What's your relationship with investing?
I think we're all here because we want to learn more and how we can get better at it. So if we are in some of it, how can we maximize what we're investing today?
Exactly, exactly. A lot of times you know what to do, and you all had very brilliant answers about why it's important. But when it comes to making decisions on the regular, maybe you feel like you want to know more, but you don't. Maybe you feel like you're a novice, but you want to be at the advanced level. Maybe you feel scared. Like, we talked about Jasmine Bitcoin, like, not really ready for that yet. So there's apprehension. Sometimes I hear people say that they have a really poor relationship with it, that it's scary. They don't want to touch it. They don't want to part with their money. There's lots of reasons why you have a different relationship with it. And the reason I start this conversation with your relationship and how you feel about investing is that if you don't get a handle on your own relationship with investing and start slowly taking action, you may never be where you want to be. Because what we know and how we feel sometimes are very different. When you know better, you do better, hopefully, but without the right guidance, without the right language, without the right conversations or mentors, you may not end up taking the right action. And so I know my business exists today because one, I've rebuilt from financial failure. I know what it's like to go through it. I know how scary it is. And I know what it's like to not know anything about money. When I started in the financial industry, it was like drinking from a fire hose. And I want to make sure that I provide a platform here and other places where at least you can talk about it. You can ask questions. And over time, you can layer by layer level up so that you can get to the point where you have millions, hopefully. And then every level of financial elevation requires a different level of mentoring and knowledge. So what's most important is that you own that. It's important. Let's make sure that you're taking baby steps to get there. I know this. You can't afford not to invest. You already get that. You've said that. And if you don't invest, you could be in the exact same place as you are today financially if you don't. Not only do we invest in ourselves, but we invest in the planet. And does anybody remember the formula that I gave from last class, the 3 ways we invest? I don't know how many of you were there. There's 3 ways we invest. And you're doing these every single day, even if you're not in the stock market, even if you aren't investing in Bitcoin or homeowner. Every single day, you're making choices about where you invest. And that's in time, a little clock. That's with people. So by being here today, you're investing your time with people, and you also invest your money. When you look at investing that way, everything changes, because then you realize that the choices that you're making across the board in your life are positioning you to continue to grow, not just financially. How does that change the way you think about investing or wealth by thinking about it in these 3 ways versus just financially?
I'm very relationship driven. So even having to work from home, it's been tolling on me. So knowing that I get a lot of energy being around people and spending my time with people is like a deposit to myself.
Exactly. So with money, definitely we want to make sure you know more about money and that you're investing properly with money. But knowing that every single day you've got to be filling your cup, and that people are your currency. So when you're out networking, when you're out making choices in your career, the people that you surround yourself with are just as important as the money that you're investing in an investing app or in your portfolio. Thank you for sharing that, Jasmine. How do you spend your time? is how you spend your money. And your relationship with money and how you spend it is intimately connected to your ability to have an impact on the planet. It is all connected. We can't afford to invest. We can't afford not to invest in one another. So as you think about wealth, that's why the Epicurean Foundation exists, is that someone, some people, some group of people said, hey, you know what? We've got to invest in our future. And that's you. And you're here today as a result of that, which I think is really cool when we open up the conversation about investing. Today, I want to give you the 3 keys, which we talked about a little bit at the front end of this conversation. In my world, the 3 keys to investing are: first, learning how to save; 2, educating yourself, which is why I know you're here; and starting young. Also, I want to dispel any myths that you might think. People have different limiting beliefs or beliefs about what wealth is and what wealthy people do. Having been around them in the industry, there were certain limiting beliefs that I had about wealthy people, having not grown up around a lot of money. So I share these as just a rounded conversation about what wealth is and maybe what it's not. But did you know only 20% of millionaires have inherited their wealth, meaning that it came from family inheritance? 80% have made it on their own and are first generation millionaires. The fortune they have will disappear by the second or third generation statistically. So most millionaires on the planet are first generation millionaires, meaning they did it themselves. How cool is that for you to hear? And hopefully that's motivating for any of you who might be first generationers too. 80% of millionaires go to work. Only 20% are retirees. So people are actively working for that wealth. And the average millionaires go bankrupt at least 3 times. So it's not always linear, right? It happens based on decisions and based on lifetime experiences. My story, right? Like I lost it all nearly, and I've got my comeback, my second comeback in my 40s. There's a popular notion that rich people don't pay taxes. Not true. In reality, millionaires pay 40% of all taxes. The longer an ancestry member lives in America, the smaller their chances to become a millionaire becomes because of a high consumption lifestyle. For any of you who have studied economics or spending in America, it's at an all-time high. First generation Americans are generally self-employed, which is a huge indicator of wealth. Like you said, I think it was Jasmine, you can save, but how are you really investing your money? And it's business owners. The top 2 professions that actually earn the most amount of wealth in America are entrepreneurs/business owners and salespeople. Why? Because they know how to make money, not just invest it. They know how to go out and actively make it for themselves. Carlos Slim Helú is a Mexican billionaire who owns $30 million a day. It's hard to imagine that kind of money coming in. For myself, it sounds very overwhelming, but he does. And he lives in a modest house with no luxuries. Bill Gates has declared that he'll donate all of his wealth, leaving a maximum of $10 million to each of his children. So 10 million is still a lot of money, but we know he's worth way more than that. And he's that giver. He's in a giver's game. The cars millionaires love are Ford, Cadillac, and Lincoln. Growing up in Vegas, you see a lot of Ferraris, Lamborghinis, hot cars. Today, we see a lot of Teslas. And in reality, that's young money, and it may not even be their own money. Those things may be leveraged. But a lot of millionaires drive very reasonable cars, and they avoid expensive cars because they give little return and depreciate in value. So that's also a concept in investing. 85% of millionaires read at least 2 books a month. So they're investing their time, they're leveling up, they're learning more, they're reading more. 63% listen to audiobooks. So going back to that conversation about time, people, and money, it's everything that you do on a daily basis to level up your life that contributes to the greater whole of your own wealth and others. Is that valuable to hear? I can't see any of you. Jasmine, you're the only one I can see.
Yes, that's very valuable to hear.
Ashley, Karen, what comes up for you listening to that information?
Well, with me, oh, go ahead, Ashley.
Go first. Okay. It's kind of just like eye-opening just to see like the statistics with how 80% kind of are first generation millionaires. So because I feel like a lot of the time you have the mentality with like pop stars and stuff like oh, like, they had a family member who already had money. But when you gave us that statistic, it's like, oh, we can actually do it for ourselves. And I like how you put in there that entrepreneur, business people, and salespeople typically make the most money. So.
Yep, they're the top earners. Awesome. Karen?
Very similar and definitely very encouraging as well.
Awesome. Awesome. So the question is to invest or not to invest. And of course, we would all say invest, right? Yeah, invest across the board in your life. I want to show this quick video, and it explains. Now, for those of you who are like me, okay, I got my degree in communication studies for a reason. So if I can learn money, anybody can learn money. When I chose my major in college, so this is how I advise other people to do it too. I was like, open up the catalog, which we don't have paper catalogs anymore, but open up the catalog and find material and content that interests you. When I opened up my catalog, I was like, which degree requires the least amount of math? So I poke fun at myself to, money's not rocket scientist. It's not rocket science. And also we can keep it simple. So the concept of money, the time value of money is something that I want you to walk away with, but you don't have to know how it works exactly. If you're more interested in more information, Investopedia is a great resource.
The time value of money is a concept that states $1 today is always worth more than $1 tomorrow. Suppose Steve wins $1 million in the lottery today. Before accepting his prize, Steve has to make a decision. He can receive the prize money now, or if he wants, he can collect the money in 1 year. Steve considers his options. If the money is taken today, he can deposit it in an interest-bearing savings account at the local bank that offers 5% interest per year. If he decides not to take the money today, he has to wait a full year with no money and no interest. Steve's not crazy, so he decides to take the $1 million sooner rather than later. When the money is withdrawn after a year, it has grown to $1,050,000. By taking the money early, Steve earned an extra $50,000. This is the time value of money as it applies to interest. $1 million is worth more today because of the possible interest that it earns over the 1 year's time.
Simple concept, right? Money today is is more valuable than it will be in a year if we take it today. Okay. Who do you think knows this best? It's a trick question, but maybe if you know money. Who knows this concept really well?
Investors.
Yep. Investors. Absolutely.
People granting loans.
Yes. Banks. You bet. And the IRS knows this really well too, because the IRS wants you to pay taxes when?
Upfront.
Exactly. And they hold on to the money. And then you might get a refund, but they're holding on to your money interest free. Right? You're giving them your money. You're giving banks your money. Banks are paying you interest, but the IRS is not. So that's just a bigger concept. Again, this is a huge wormhole. Like I said, I'd love to come back and teach a series on this because it's really interesting once you start having the conversation. But my intention today is not to go down that wormhole. And here's an example, right? $20,000 today is worth more today than it will be because of inflation and because of the time value of money. But if you don't invest it, it's going to be worth $20,000 in 20 years and less than $20,000 because it won't have the same purchasing power. Saving, if you get a 2% interest rate, it's still going to be a little more, but then investing it in some type of investment that will compound over time, their $20,000 goes to $99,113. That's a big difference. 30 years. That's a big difference, right? Huge difference. And then it just continues to grow. Here's another example. And I'm happy to share these slides with you. And I know this presentation is being recorded. So Melissa, I'll send this, Ashley can send you the slides after this if you want these, because I think they're really powerful. With an annual return of 8%, so you invest your money and on an annual return rate, you get 8%. At the age of 25, how many of you are 25 or close to 25-ish in your early 20s? Yeah. So you invest $5,000. That's less than $500 a month. So $5,000 at the end of the year, it's worth $5,400. You invest $5,000 for 10 years, and that money is worth $89,886. If you don't invest anything else because you started at the age of 25 on an average return rate of 8%, this is just how compound interest works. It's over $500,000, $615,580. So you've invested 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, $55,000, and it grows to over $500,000. You take the same $5,000 10 years later, at the age of 35, and you invest it, and what do you see? Over time, you still can't make up that 8% over year after year. You have to invest more money. So total invested $55,000. On the other side, total invested $130,000, and you have $200,000-ish less. So time matters, right? You kind of know it, but do you really know it, right? And like Melissa, before some of you hopped on, Melissa's like, well, I don't know, buy the shirt, buy the coffee, or go out with my friends. Of course, do those things, but also know that if possible, we set some aside for it to compound and grow over time. And this is the magic formula. Assets minus liabilities is your net worth. When you start looking at your finances this way, when you start tracking not just what's coming in and going out, but you're starting to track your net worth, meaning everything you owe and your liabilities. Most of you don't, I learned this last time, most of you don't have loans because you've earned scholarships, huge investment, and kudos to you because now you're not paying the opposite of interest being paid to you. You're not paying interest on the back end of those loans, but tracking your net worth, everything you own minus what you owe, liabilities, car loans could be what you owe, mortgages could be what you owe, those types of things. That's the magic formula I want you to track. We know assets, as you own them, they appreciate. So real estate's a good example of that. In the interest, well, it's 10:30 actually. What I want to do is how many of you have a basic understanding of types of investments, different kinds of investments? Jasmine, Karen, I can't see the rest of you.
I don't know how to not raise my hand, but I definitely have no idea about anything.
Okay, good. So I'm going to share this short video just to provide an introduction to the next part of this conversation. Is this valuable so far, you guys and girls? Yeah.
Yes.
Absolutely.
Okay.
As you're speaking to investments at the end, could you maybe give us some of your favorite investments that you
have that ready to go? Yeah,
okay,
have that ready to go. Yep. Okay, cool. So let's watch this short video. I think it's going to take me to YouTube. Okay.
So you've got a 401k. Now what? Even if you leave the heavy lifting to the brainiacs at Guided Choice, it's a good.
I think it's my screen stopped sharing. Technical difficulties. Okay, let's see if this works. What do you see, Jasmine?
I think it's actually about
we see the video now. We're good.
You're good? Okay.
Yeah, we're good.
Good idea to know how investing works. And if you're the do-it-yourself type, you need to understand how to invest appropriately. Don't worry, we're not going to show you tons of math. All you need to know to get started is that there are 3 big types of investments called asset classes: stock, bonds, and cash. Stock is just ownership in a company. There are many ways to classify stock. 2 major ones are size, called market capitalization, or CAP, and company location. Each classification has its own typical level of risk. Large cap stocks include the 500 biggest companies in the U.S. Apple, Walmart, Disney, Ford, McDonald's. Ever heard of the S&P 500 or blue chips? Same thing. Keep in mind, all stock is risky, but these are generally considered the least risky. Mid-cap stocks include roughly the next 400 companies by size, smaller, but still fairly well established. They're considered riskier than large cap. Following large cap and mid cap, take the next 2,000 companies and you've got small cap stock. While they have potential for greater growth, they also have the greatest risk. Then there's international stock, ownership in companies located in developed nations outside the US, like BMW in Germany and Sony in Japan. They carry about the same level of risk as US-based large cap stocks. The highest level of risk is found with emerging market stock. This is stock in companies located in developing nations like India, Mexico, and Russia. There are two ways to make or lose money in the stock market. You see, when you own a stock, you actually own a piece of a company. And as the value of that company increases, the stock price goes up. But if the value of the company goes down, the stock price goes down too. These fluctuations determine the amount of profit or loss. Another way to make money is when the company shares its yearly profit with you in the form of a dividend. Stock prices can go up or down dramatically for all kinds of reasons. As a result, stocks are the riskiest types of investment in your plan. But over a long time, they can also be the most rewarding. Next up, bonds. Bonds are just a loan to a company or government. They borrow by selling a bond, which is simply a promise to repay the buyer in a fixed number of years at a fixed interest rate. When you hear about the US government borrowing money, have you ever wondered who they borrow from? Chances are it's you, through the investments you make in bonds. If interest rates go down after you buy a bond, its value goes up. If interest rates go up, then your bond value will go down. How much the value goes up or down with a change in the interest rate depends on how long the bond is. The longer the bond, the more risk, as the more the value will go up or down with interest rate changes. However, in general, bonds are less risky than stocks. Cash is, well, cash. In a 401k, it's usually available as a money market or stable value fund. Unlike other assets, there's little risk that your money will lose value. But that doesn't mean there's no risk at all. If you hold too much cash, you are at risk that inflation will leave your money worth less compared to everything else. For example, in 1950, a nickel would buy you a Coke. But if you saved that nickel until today, you wouldn't have enough to buy that same Coke. Cash loses value over time. Most people with 401k plans invest in mutual funds. These hold many different individual stocks or bonds chosen by professionals for a given level of risk and potential reward. So, how do you choose the right mix for your specific needs? You may be surprised to hear that according to the majority of corporate pension plans in the world, there really is a single best way. It's called modern portfolio theory. The details are a lot of math, but understanding what's behind all the numbers is remarkably simple. In fact, you've probably already heard of it. Don't put all your eggs in one basket. You balance risk and reward by holding lots of different types of investments. The technical term is diversification, and it's the name of the game in investing. So how do you do it right? Most of us understand that if we take more risk, we expect more return. Let's look at the math. The line shows us that for any given level of risk, we can expect a certain rate of return. More risk, more return. The challenge, as you may be aware, is that markets don't move in a straight line. They go up and down. The goal is to buy low and sell high. When one investment type is down, you want to buy. At the same time, you want to sell an investment that is high. In the long run, they all tend to move up, just at different rates based on risk. Remember, this is your retirement savings. So to invest well, you need to diversify. The goal of diversification is what modern portfolio theory is all about, getting an optimal rate of return for the risk in the long run. To do that, you want to invest on what is known as the efficient frontier. The details of drawing the curve are just a lot of math. You could spend the spare hours of your days creating the efficient frontier on a very large spreadsheet, or you can let experts do it for you. In fact, The answers are already right where you want them, online, and probably already in your 401k plan. Guided Choice can give you personalized advice recommending a specific mix of stocks, bonds, and cash to reach your retirement income goal. You can even use it to try different strategies and project the results. Whether you take the investment recommendation from our brainiacs or choose to do it yourself, hopefully now you're a little more confident about how retirement investing works.
All right. What's one thing that stuck with you in that presentation? One thing maybe that you learned that you didn't know.
I'm probably the oldest alumni, so
You know some of
I
this.
have gone through different workshops, but I'm reflecting on it myself to say where are my investments today.
Yep.
And you called me out that I am risk adverse already. So yeah, I only have money within those large caps. So I probably can play around with some small caps.
Yes, I agree. Maybe even just a smaller percentage to capitalize on the volatility, right? So, so it brings up a good point. Diversification doesn't just mean that you have some stocks and bonds. Diversification also in your stock choices allows for you to capitalize on opportunities. And if you look at your portfolio and you've got the majority in one area, you're missing out on opportunities in other. And that is definitely something that I see with my, I teach money types, money personalities, which I would love to come back and teach you guys. But this is my cheap chip where you're risk adverse. And so you tend not to take risk, but then you're losing out on that opportunity.
Mm-hmm.
Yep. Thank you for sharing that, Jasmine. Anyone else? What did you hear? Did you learn something new?
While they're thinking, I have a question really quick, Lisa, if that's okay.
Sure.
So I'm getting to a point of my career where I'm interviewing and they're offering stock options. And I'm wondering what is an appropriate stock option? That depends on the company and what's available. So what are some averages that you saw with people who had that within their offering as a benefit from working for a company?
It's a loaded question.
Okay.
Yeah, but you are welcome. Let's schedule a call and look at that together if you want. Okay.
Okay, thanks.
Yeah, you got it. Stock options are a great opportunity and every company structures them differently depending on the size of the company and the age of the company, all those things.
Okay, great.
Yep. Well, anyone else want to share? Go ahead.
Well, so listening to what you said is the best way as you're kind of getting your first jobs is to really just look at your company options for you, or is that how you suggest everyone gets started?
I think it's a great start, especially if they offer like Jasmine stock options, 401k. It's money that comes off the top of your earnings. So we can make sure at least you have a portfolio in your 401k that aligns with your values. And I'll talk a little bit about that in a minute. It's a great way to do that. And then also thinking about extra money that you have every single month, if you can save that and start to invest, and I'll give you some suggestions on how to do that on your own. The more you invest, even if you're dabbling in different areas and educate yourself, the better off you'll be in the bigger picture of things. Because with 401ks too, we don't have a lot of say in how that is invested. And I think that's one great option though, Melissa. That is a good start.
One thing we taught all of the I worked in early career, so all of the new hires that would come in were look to see how much your company will match. And you want to at least do that because that's like scholarship money for, professionals. That's free money that you're leaving on the table if you don't take advantage of it.
Exactly. And that's how I was able to get to $100,000 so quickly, is that UNLV was matching. And at that time it was maybe 7-8%. And now it's even higher. So companies have really leveled up or stepped up in what they're able to match. Yeah. And then if you're, let's say that you match 3% and that's 6% then, and then there's compound interest and that money just starts to grow and you don't have to, you're working for it, but then it's going to start to grow even more than what you're working for. So that's a really great point. All right. I'm going to keep going? I know this is a lot. Hopefully, at least you're starting to feel a little bit more confident in what kinds of questions to ask. And I think that's the most important part. So we've got these different asset classes. And here on the left, we have cash, savings accounts, online wallets, hard cash, cash under the mattress, right? And you can buy things now. You can buy things right now with that money. And then we've got equities. So ETFs are pretty hot in the news right now. These are funds that are electronically traded, mutual funds, startup funding, stock. So stock, you own a little piece of that company when you have stock. There's fixed income, meaning for those of you who this is new, just know that the difference between equity and fixed income is equity is you give them money and you buy a portion of their company, just to recap. And then fixed income, you're loaning someone the money and they're paying you interest because it's a loan. And that's the difference between a stock and a bond, basic. Then there's real estate. There's lots of real estate investment trusts, REITs, commercial property, bungalows, plots, flats, and of course, there's your own residential real estate that you can own, and lots of different ideas on which is better, which we're not going to get in today, but there are some people who are like real estate's the way, and other people who are like the stock market's the way, or ownership in companies is the way. I believe that there's a balanced approach for you. Somehow we just choose what makes sense for you, like Jasmine said, based on your own risk tolerance and what you're able to save. And then we have commodities, where right now commodities are pretty hot given all the fluctuation we've seen in the world over the last couple of years because of COVID. And we have people who are exclusively buying silver and gold, for example. You can do that too. I don't know if you know that, but in your own portfolios, you can own commodities just like you can own stocks and bonds. And having a balanced approach, this is a good example of, this is someone who is nearing retirement, because you'll see they've got more bonds, which are less volatile, and a little bit less stock, some cash, some real estate. So as you're looking at investing, we want to make sure you're not just putting all your eggs in one basket. That's the modern portfolio theory. What is volatility? Just as a basic, it's a statistical measure that measures the range of possible returns, giving a security or an index. So market volatility, if you watch CNBC or you watch different what am I trying to say? TV shows. Who watches TV shows anymore? But you know what I mean? Channels and shows. They'll talk a lot about market volatility. Every day, people are measuring market volatility. And this is exactly what you were talking about, Jasmine. When we look at the average volatility of different types of assets, they're very different based on what kind of asset they are. So Bitcoin, we'll see, is really, really volatile. The one thing I tell to my clients is, one, I really truly believe, which we've got a few minutes, I am going to talk about Bitcoin for the sake of understanding what it really is and why you shouldn't be afraid of it. Most people are afraid of it because it's so volatile. I think right now is a really good time to put little bits, like some of my clients are putting money into Bitcoin. But here's the thing, because of the volatility, because of the highs and lows, it's like money that you don't want to bet on for your long-term future, right? If you got different pots of money, let's say you've got $500 a month to invest, that $500 can be broken out into a number of different places for a number of different reasons. Maybe $25 a month goes into Bitcoin for now. You can still invest, just maybe don't put your whole future in its hands, right? Commodities are a little bit more volatile than the S&P 500. These are stocks. So know that, and know that a good portfolio, even with your 401k, can have a mixture of these different volatilities, because as the portfolio managers are buying and selling all day long for your portfolio and for the goals that you have, they're taking this into consideration. You want to have some that are less volatile, some that are a little more volatile, and it takes good partnership and mentorship with your financial people to make sure that you're making the right choices for yourself. So we've heard all the rage about blockchain. I'm going to send this video, in the interest of time today, I'm going to send this video in my recap, where in order to understand Bitcoin, it's really important for you to first understand what blockchain is and what it isn't. Bitcoin is the most popular form of blockchain right now. And for a lot of reasons, it is. But there are also many other kinds of blockchain. And the way that blockchain is designed, actually, it's more than just financial. You can store important documents via blockchain technology. You can file documents via blockchain technology. It's not just money. So take the time to educate yourself. Like I said, the 3 keys is learning how to save, educating yourself, and then just getting into action and doing it. So here's Bitcoin, just to educate you a little bit about what it is. It was created by Satoshi Nakamoto in 2008. So it's been around a lot longer than a lot of people think. It's digital money that allows for secure peer-to-peer transactions on the internet. This is different than buying stock or buying bond. Someone asked me, why would you do this? Well, there's no exchange. Internationally, why would people do this? Because it's peer-to-peer. It's not a country to country. It levels the playing field when it comes to currency exchange. It's decentralized. Any 2 people around the world can send Bitcoin to each other without a bank, government, or institution. There are a lot of benefits to that. And also what we saw recently is China was like, shut it down. We don't like this one bit. And for good reason, because they don't get to see the benefit of that either. Every transaction involving Bitcoin is tracked on a blockchain, which is similar to a bank's ledger. And so it's not regulated, which makes it very volatile. And different people have different feelings about it. And definitely it's not the main source of currency for sure, but it does have a future in our society. Unlike the bank's ledger, Bitcoin blockchain is distributed across the entire network. No company, no country or third party is in control of it. This I thought was really interesting. So when I started learning about it, I was like, oh my gosh, this is like a game. It seems like that. It feels like a virtual game. There will only be 21 million Bitcoin ever. It cannot be inflated or manipulated in any way. It isn't necessary, so you may not know this. At one point, you weren't able to buy more than just one, or you weren't able to buy portions of Bitcoin, but now you can. You can buy an entire. You don't have to buy the entire Bitcoin. You can buy just a fraction, like I said, $25 at a time. Then you get into the game. You start to see how it works, and you start to monitor it, just like you would any other stock that you own. There is a video. You can watch that if you'd like, and I'll send that with today's recap, but we're not going to watch it today. And here, this speaks to the volatility. So it's been in the news a lot. Bitcoin's been in the news a lot. We know.
Imagine for a second.
Oh, sorry, hang on.
You are in charge of the task.
The video started without me.
But you get this task today.
That scared me.
Not in the 12th century when money was initially invented. You're basically asked to find a way for people to exchange.
I apologize about that. Okay, can you see my screen again? Yeah.
Yes.
Thank you. So what happened recently was that Bitcoin was hovering up here for a while. This is, what's the value? We saw it go way up. And it had a good run where it leveled out in November of 2020. And then it hit an all-time high. It had a really high run. And then recently, which was in May, it came right back down again. And so the concept from investing, what I want you to take away with more than anything else today is not to be in the emotional game of investing. A lot of emotional investors, when they see it running up like this, they want to buy it because they see it going up. And this was the mistake that I made in 2004 when I bought my first house. The market was going up. I was afraid of getting bought, like I was afraid of the market going up too high, and then I was going to get priced out of the market. So I bought a home at an all-time high in the market. And then what happened? It came right back down again in 2008. And the value of my home went from $267,000 to $100,000. Same thing applies in the stock market with Bitcoin, with any stock that you have or any investment that you have. You want to buy low, and value investors get this. and also in the market today in real estate, you buy low. So as you watch Bitcoin or as you watch your investments, the right time to buy is when you see these dips. Well, you can still make money when it's down low here and it comes back up. And you can also still make money when it comes down low here and it comes back up. So like Modern Portfolio says, is it doesn't matter all the time that you buy at the lowest. It's just that you watch it so that over time you earn money on the investment. Is that valuable to hear? Karen, I see you shaking your head.
Yes.
Definitely. Definitely. So now's a pretty good time to buy Bitcoin because we know it's going to go up. I'm not an advisor. I don't have my licenses. I can't officially say go buy Bitcoin, right? But this is the type of way that you want to watch any investment when you're ready to buy it. Cryptocurrencies have a lot of criticism for a lot of reasons, especially the volatility. And it's just important to be aware of it. And I truly believe that they're not going anywhere. They're just really volatile right now, just like an emerging market would be in a third world country. I don't know if you know this, but by 2020, there were over 10,000 types of cryptocurrencies. So it's not just Bitcoin. There's coins and there's tokens. It's important to know the difference. I have some resources here. There's different types of cryptocurrencies: Ethereum, Ripple, Omni, NXT. These are coins that you can buy through Coinbase, which is an app I'll talk about here in a minute. There's also altcoins, Digicoin, Litecoin. There's different ways that you can start to learn about and eventually invest in cryptocurrencies so that it doesn't become something that you're afraid of, that you don't do, and then you miss out on all the amazing opportunities of being a part of it today. You can learn more. Investopedia is always my go-to. When I was getting my licenses to become a financial advisor, I used Investopedia a lot. They actually have an Investing 101 class that you can take. It's very inexpensive. And if you want to learn more, that's a great place to start. Also, Coinbase. Coinbase is the most well-known app for exchanging, buying, trading Bitcoin and other coins and tokens. So I highly recommend that you go to Coinbase. There's also some great blogs, but Coinbase is a great place to get information. And also one of my favorite podcasts is the So Money podcast. But I'll send all of this as a recap. Investing apps, to your question, Coinbase is where you can do the investing in Bitcoin and the different types of cryptocurrencies. My two favorite investing apps are Acorns and Ellevest. The reason for that is that you have to, in order to invest at Acorns and Ellevest, they have gone through very strict vetting processes, just like any financial advisor would have to in order to be able to invest your money. They're a third-party investor, meaning you tell them how you want this money to be invested, and they will match you to funds and do the work for you. But they're very inexpensive, and they're doing their part also in educating and doing socially responsible investing. And so I'll talk about what that is in a minute. There's also something called Robinhood. Now, Robinhood got in a lot of hot water. I don't know if any of you heard about it or paid attention to it earlier this year, where they shut down trading for GameStop. So with Robinhood, you can buy actual stock. They make it very easy. And depending on your risk tolerance, you want to choose companies and looking at the different asset classes. Of course, you're just going to buy stock on Robinhood, but it's a great place to go buy Disney stock, or it's a great place to go buy company stock, Tesla stock, whatever companies you're interested in. You can do that, and you can sell it on Robinhood too. What I like about those first three apps is it's easy to send money over, and it's easy to get your money back. You have to pay attention to the rules. Of course, in Robinhood and Wealthfront, you can only sell when the market's open. So if you wanted to sell or trade stock, you can only do that during open hours, but they do their due diligence in making sure that that money gets back to you also if you choose to cash out. So I like those a lot. Ellevest is my choice for women. It's actually my choice for everyone, especially if you feel like you want to support women causes. It is owned by Sally Krawcheck, and she has been in the finance industry for a very long time. and it's all about impact investing. There is something that's called impact investing, and there are different types of groups that will match your money to socially responsible companies based on your values. We talked about this when we were together the first time, and I think it's important to note it again that your money, especially when you're in stocks and bonds, is supporting companies. And companies, as the fabric of our society, are making choices every single day to be responsible actors in the world or not. Public companies, they have to be public in order to be traded on the exchanges, and they have to file annual, quarterly, biannual reports that share what they're up to as companies. So as an investor, when it comes to educating yourself, you can research companies that are great actors in the world. Can you invest in private companies? Absolutely. But public companies is where all that information is on the exchanges. And I would recommend that you start there for your own safety and for educating yourself. So Ellevest is a great option, and they match to women-owned companies and also socially responsible companies. Just know with apps and checklists, make sure that it's regulated. I would highly recommend that to get started. Like we said, Bitcoin is not regulated right now. If you want to start investing on your own, choose regulated areas. Watch your money, track your money, fill out your risk tolerance. So if Ellevest and Acorns, they make you fill out a survey for your risk tolerance before they match you to funds, which is good. They're going to say, okay, she's not as risk tolerant. We're not going to put her in these really aggressive funds. That's important to know. And don't save or invest without a strategy. Strategy wins at the end of the day. The people that are going to win and live their best lives and are going to have all this wealth are the ones that learned how to save first. So if nothing else, hopefully you heard that today. Ask questions, make a plan, follow your dreams. It doesn't always have to be about the money. Tell others what you want and bring others on the journey with you. So that's my spiel today. I really hope that you had fun. I could talk about this all day long. I will stay for a couple of minutes for questions, and then I'll hand it back over to Melissa. I have another meeting to get to, but I am so grateful to spend this morning with you. Please have me back. I can do the money types. There's all kinds of conversations we can have. If it's valuable for you, I would love to be here. So thanks, and thanks for your participation this morning.
Thanks, Lisa.
Yeah.
Thank you so much.
You bet. Any questions?
Thank you so much, Lisa, for being here and for all the information. It was definitely very valuable. I learned a lot. Also, it's also good to have that good refresher. I did have a question, kind of in regards to piggybacking on the Bitcoin.
Mm-hmm.
Part of my portfolio is to invest in investments other than just the dollar, right?
Yes.
So, for example, what are some of your favorite ways if you invest in foreign currencies, whether that be through ETFs or whether that be through real estate?
I don't invest in foreign currencies. And actually, in full transparency, I'm a financial delegator. So my financial advisor handles most of that in the portfolios. So I would just say, looking at the overall philosophy, I think Forex might be a good place to look. Bitcoin, again, that's not really an international foreign currency, but buy low, sell high. So look at foreign currencies that right now are on value that you can buy. So then over time, you can benefit on the upswing.
Perfect. Again, sorry, can you repeat that name of it one more time? Forex?
I think Forex, Forex. Check out Forex.
Thank you.
You're welcome.
Hi, Lisa. I have a question. I wanted to know if it's possible to ever, okay, let me backtrack. So you showed that that kind of spreadsheet where you talk about investing at 25 versus 35.
Yep.
Let's say you have in mind, you know how much you want to have when you retire, like that's
Yep.
your lifestyle cost. And let's say that you had planned at 18 years old, but life happened, whatever, you didn't start at 18. So now you're starting at 28.
Yep.
Can you ever get back to that number? Like, is that, because I know basically it's all about the time, but can you ever make up that number again with money in any way?
Yeah, you can make up the time. The money, no, right? The $5,000 was way more valuable at the age of 25 than it was at 35. But the way people make it up is on interest, dividends, earnings, and being smart with the investments they're making, or just putting more money in the different forms of investments that are available. So it all correlates to the time. And then looking at that goal, and then looking at that statistic that the average millionaire loses their wealth 3 times in their life. I've heard crazy stories of people who've lost it all and come back. So yeah, you can make it up, but it's in knowing that the investments that you choose at 25 aren't going to be the same ones at 35 in order to get you there. And it might cost you more money.
Okay, thank you.
You're welcome. Okay, with that, thank you so much, Christopher and Melissa. Please have me back. Thank you all for your participation today. Let me know what else you're interested in learning about. These are both high-level conversations designed to be an introduction. And I'll bring back my experts too. I have other people in my world. So Melissa, I'm going to toss it back over to you.
Thank you, Lisa.
Yeah. And I'll see you all next time.
Thank you.
Thank you so much, Lisa.
Okay. Bye. Thank you.
Hi, everyone.
Oh,
so Lisa has a great book called Girl, Get Your Shit Together. And it's actually, I'll send everybody the link to it, but it's worth it. It's a quick read. It's worth a read. And yeah, she gave us a free link last time, so you don't need to go on Amazon and buy it or anything, but I'll send it out to everyone.
Thanks. I just, I attended the Executives of Chicago. My company sponsors the Young Professionals Group to attend. So because we're all interested in investing, I wanted to share the 3 top economic advisors in the US they always ask them at the end of the conference, if you had $100,000 to spend, what would you spend it on? And one said copper, and the other said electrical vehicle batteries, because these are things that are moving towards the future. So just wanted to share that something I learned, and they do this annually. So I'm happy to share it each time I go.
That's very interesting. Thank you.
Yeah. One other tip that we give to the new hires is when you sign up for your 401k, you can select the stocks or bonds or your portfolio mix you would like, or you can select a year-based. So you'll say, I plan on retiring at this age. So then they will manage your portfolio for you based on the time that you think you're going to retire. And I think that's a lot easier and a lot more welcoming for people who don't feel like they want to look at different stocks throughout the year.
Thank you.
Love it. Yes, Jasmine. And definitely take advantage of that 401k match if your company offers it. I have grown my portfolio so much, and it was thanks to that, you know, at the very beginning of it, at least.
Mm-hmm.
It's good to see familiar faces. Jasmine, Daniela, haven't heard from you guys in a while.
Yeah, this is wonderful.
Yeah, hi guys. Sorry, my camera doesn't work.
Well, it's good to just hear your voice and see your name. But well, if you have any other topics you want us to expand on, I mean, I know this is sort of a just getting started, but if you have that next level of topics, send them to me and I'll coordinate with whether it's Lisa or the ECF financial advisor, Lee, and have them talk about what's next. Because I feel like, you know, a lot of times they kind of start from the beginning, whereas we're all sort of getting some knowledge on it, but they don't want to leave anybody behind. So I think it's, you know, she gave us some great sites to get started on. If you don't have a 401k, you know, that's something where you can look at other sites and kind of create your own IRA, but where you get, you know, they're diversified, making sure you have that safety of a 401k or an IRA. I mean, IRAs are really, really important. But, you know, she was kind of just talking on that next step, that investing, that getting started and, you know, taking a little bit of risk.
Thank you, Melissa and Chris, for putting this together. I really appreciate it because I know you guys don't have to involve the alumni anymore, but it's awesome, especially on things like this, where I wish we would have learned this in school, but we didn't. And it's just good to know because it's all about adulting.
Right. And Karen made really made this happen. She's trying to do a lot more with the alumni and get everybody involved on a higher level. So thank you, Karen. But yeah, anything you want us to expand upon? I mean, she kind of kept it very, very basic, but I think even if we, meet every few months and are like, all right, what's next? What else can we do? What worked? What didn't? Has anyone tried the apps? I think we can all learn from each other.
Mm-hmm.
I personally do use Robinhood. I've also used Webull and then Merrill Edge as well.
Okay. Which ones do you like? All of them?
Yes. I do use different platforms for different tiers of my investments.
Great. Does anyone else have anything that they want to
As
share?
alumni, is this something that you guys would want to see? Maybe like a part 2 of it, continuation of it? Now that we have this 101 knowledge, if you will.
Well, yeah, I was asking Lisa very specific questions. So it sounds like, having a one-on-one conversation might be helpful. And I helped, just increase my financial understanding. So I'm always happy to share the knowledge that I'm learning too. But sometimes you don't know what questions to ask because you don't know what's out there. So I love kind of that she dabbled